Welcome back to Lamb's Cryptoverse. Now that you had a lot of time to take in what happened today with uh, with the stock market, with the bond market, and yes, Sam Bankman-Fried. Now we're not going to talk about FTX today. We're going to talk about this great inflation report. Uh, the report was so good that it caused oops, it caused the stock market to go up dramatically, and the Nasdaq had its best gain. Actually, all these indices had their best gains since March of 2020. And bond rates. Let's see if we can get bonds here. Markets. Bond rates had some of the biggest declines in maybe a year or more. And you can see here. So this is pretty tough to see. This is like the old Lehman Brothers index here, basic LB. Yeah, the U.S. aggregate went up 39 points of 1.9%, and the global aggregate went up 3%. So these are big gains. And but the year-to-date return, the 52-week return, is still the most probably in history. And the 60/40 portfolios, you may know, has been doing the worst in history because usually bond prices go up when stocks go down, but it's not happening this year because of the Fed's job with inflation. But what I want to talk to you about is some of these inflation numbers using something called trading economics. So basically, what it's shown is that we had 7.7% right here. I'm going to highlight it maybe. Uh, right here, we had a 7.7% increase in October, and that's much lower than what we had in the previous month of September, and it was lower than the consensus from economists as well as trading economics. They have their own forecast. So basically, this is a really good number. And not gonna go to other details, but basically the core inflation rate was also better than expected. And another good thing, which I should have mentioned, is that inflation peaked in June and it's been going down rapidly. So it doesn't look as good for the core CPI. It's been more like up and down, but still the numbers were better than expected. So because of that, the CME FedWatch tool, which by the way is saying the next meeting is in 33 days, that FedWatch tool is predicting about an 83% probability that we're going to get a 50 basis point hike during the next meeting. And this meeting ends on December 14th. And just be aware that the day before that meeting, the next CPI is coming out for November. So that's data that the Fed's going to use. But as you probably know, the Fed's pretty disciplined when it comes to data, and they use all the data that's coming in, and they look at every single data point that comes in. Yes, they weigh the inflation data, the CPI data a lot, the PPI data a lot, and the PCE data a lot, but they're also looking at other data too. And Jerome Powell actually admitted in his last meeting that he realizes that the data is lagged, and he also meaning the CPI data, and he also realizes the housing data is lagged. And he realizes that there's going to be a time lag between when the Fed raises rates and when the economy is actually affected. So that's pretty interesting. The next thing I want to talk to you about, and this is really important, is one topic, but two items of note. The first one is this. This is from Charlie Bellello, and basically what he says is, forget about because everyone's hoping that the Fed stops hiking rates, that they just keep them flat. But forget about that. What if they even pivot? Even the Fed is aggressive and they pivot. According to Charlie Bellello, the S&P won't bottom to many months later. And I'll give you one example that he put here. Let me make this higher so you can see it. Maybe I should just hold on. Let me just fix it here. There you go. So basically, the Great Financial Crisis, basically, that's from 2007. No, that was a pivot. So Great Financial Crisis was something like between 2007 and 2009. But the Fed pivoted in August of 2007, but it wasn't until February of 2009 actually I think it was March that we got the bottom, March 10th, that we got the bottom of the S&P. So that's over 18 months. And if you go to the dot-com bubble, which I think is what an analog to what we have now, because I think this was a bubble. What we have here is a Fed pivoted in December 2000, but it did not bottom until 2002, September 2002. That's 21 months. And let me just move my video here. And if you look here, the average time between the pivot and the bottom of the market is actually 14 months. So my point here, and Charlie Bilello's point, is everyone's hoping for a Fed pivot, but even if the Fed pivots, it looks like the market can still decline for one more year. And remember, these past crises, there was not an inflation problem. This time, the Fed, even if it wants to, it cannot react quickly because they've got this sticky inflation, especially from what I should say again, sticky wages, especially if you look at the service area. If you look at this ISM service index, the wages are very sticky. Remember that the U.S. economy is 2/3 of that is a service economy. So that's the key to cutting inflation. I hate to say it, it's going to be sad, it's sad news, but the Fed has no choice but to cause a recession and make the unemployment rate go up. And so I'm going to show you a visual of what I just showed here. So it's this. This is a visual. This is showing two things. Number one, it's showing what's called the yield spread. But over here, this is from the St. Louis Fed. They call it the Fred graph. And over here, they call it the 10-year constant maturity for minus the 2 years. So it's basically called the 10-2, or I like to call it the inversion of the yield curve. And so when that rate goes below zero, and that's that black bar here, this is zero. So when that when that blue line goes below zero, so when it hits that when it goes below that black bar, that horizontal bar, it's going below zero. So you see it did that, and two things about it. There's a big lead of this 10-2 and a big lag. Let me explain. So basically, when the blue line inverts, and so it goes below zero, so you could see here it went below zero as soon as September 1979. It went to minus 0.6, or minus 66 basis points. But it took months later, maybe even a year later, for the recession to hit, and that's the gray shaded area. And then you saw that again, that here it was pretty quick, but basically it started inverting in April 91, and then we got a recession, I guess in September, October 1981. But here, it was way early. Basically, the yield curve starting inverting. Actually, it didn't even invert here. It hit a low of, it did invert. I'm sorry. Maybe that horizontal bar is wrong. Oh, I got to look. The horizontal bar is referring to the right side. I'm sorry, I should explain this. The right side is the 10-2 spread, and the horizontal bar is below zero, actually. And then if you look at the left side, okay, I just realized this horizontal bar is referring to the red line, the NASDAQ, basically. So I wish we also had a bar for the 10-2 spread, but we don't. But we could just read it off the chart. But basically, so the left axis is the NASDAQ, and the right axis is the 10-2 spread. And so basically, as I was saying, there was an inversion. It doesn't look like there is because, like I said, it didn't hit the black line, but that black line is actually for the NASDAQ percent change. So basically, it hit minus 23 basis points, and actually it turned negative even earlier than that, around January 1989. But it wasn't until June 1990 that you get the recession. So there was a big lead. And then I'm not going to go over each one, but you can see yourself that there was a big lead in 99. There was a big inversion, and then there was a recession much later in 2001. And again, you're going to see that here. The yield curve went down for many, many months, actually years, right? It peaked in, and that's blue here. It peaked in July 23 at 2.7%, and it kept going down all the way until September 2006. Wow, that's unbelievable. That's 3 years, and then I guess it was a year or so later there was a recession. So that's my main point. My other point is there's a big lag, or lead, I should say. There's a lead, so when this not only doesn't lead on the way down, it leads with a big I guess lag between when it goes up. When the 10-2 goes up, the stock market's still going down. That's what I wanted to say. So I actually wanted to say two things. Number one, you can see here that the NASDAQ's still going down during recession. And you saw it here in this period. You saw it in this period in 1990. And you saw it in the 2000 tech wreck. And you saw it in the 2007, 2008 great financial crisis. That's one point. The second and last point I want to make is during a recession, the yield curve or 10-2 spread actually goes up. And you could see it over here, and you could see it here, and it started going up already before the recession. It started going up from March 1999 all the way to August 1992. That's when it peaked. And so my point is, my last point, actually, so there's one more point, you get a bonus, is that if the analogy is true that the stock market can continue declining when we have a recession, then it follows that it will decline going forward because we haven't even had a recession yet. The second point is there's probably going to be a recession because we already have a yield inversion, and not just from the 10-2. We have a yield inversion in the 10-year yield versus the 3-month yield, and even in a 30-year yield versus the 2-year yield. So that's a very high probability of recession when it's not just the 10-2s that are inverting, but it's other areas of the yield curve. So that's saying there's going to definitely be a recession. Of course, this is not financial advice, but that's what this is saying. So this is saying it's going to be high probability of recession, meaning that the NASDAQ is probably going to go down. So right now it's going up because the CPI print was good, and because of the midterm elections, and because October and November, December is the strongest seasonal pattern for the stock market. So what I'm guessing is an S&P can continue rising to maybe 4,100, 4,200 tops. And then there's a lot of overhead resistance. If you look at these resistant channels, you can see that there's, let me just blow myself up. There's a lot of resistance in S&P. There's a channel. So meaning it goes up and it goes down, up and down, up and down, but it goes down in like a staircase manner. And I think that's what's going to happen as a recession approaches. So just keep that in mind. Well, thank you all for listening. And if you have any comments or requests, or there's something you don't understand, please get back to me, because my job is to help you become a better investor and get to know macroeconomics better too. Take care. Bye-bye.